Yesterday, the official figures on unemployment were published, showing a significant rise in April, but much less than was predicted by the nation's gaggle of chattering economists. It was another example of how poor Australian economists are at predicting anything. You may be familiar with one definition of an economist, someone who can tell you tomorrow why what they predicted yesterday didn't come true today. So yesterday, economists were out in force trying to explain why they collectively predicted the unemployment rate would be 8.2%, but it actually came in much, much lower at 6.2%. Essentially, their argument is the same one they use whenever their forecasts are proven to be faulty, that the official figures are wrong. Now, the opposition leader, Anthony Albanese, calls it devastating, which I think is way over the top, and has generally sought to make political capital out of the misfortune of those who have lost their jobs. Now, turning to other news, the nation's industry superannuation funds say they're ready to deploy $28 billion worth of investment into infrastructure projects to help get the economy restarted. Industry Supers Australia's chair, Greg Combay, says partnerships with state and federal governments backed by stable policy settings could mean that this rather large nest egg is just the start. He says we've got sufficient funds available and plans to provide capital to solid Australian businesses and to bring forward large investments in major projects and essential infrastructure that will create new jobs and sustain many more. Combay says we're determined to play a key role in helping Australia's economic rebuild because they get some members working again and delivers long-term returns for all. Combay, who is a former federal Labor cabinet minister, pointed to a number of major projects that the industry funds were prepared to back, including the proposed multi-billion-dollar fast rail link between Southern Cross Station in the Melbourne CBD and Tullamarine Airport. That project, he says, is well advanced in planning and engineering and needs to go ahead. Brisbane's airport, the new $1.3 billion runway, which is Australia's biggest aviation project and scheduled for completion this year, is another example of a project they could support. Now, looking at some of the market stories that are out and about, a report released by CoreLogic shows that the recent easing of restrictions to open homes and auctions has had an impact on the market, with weekly indicators already improving. The report shows there has been a pickup in newly advertised properties from both a rent and a sales perspective. And meanwhile, SQM's monthly report shows that the combined capital prices index increased by 0.7% for houses and 0.1% for units over the month up to the 5th of May. Again, these are very small rises, but any rises in the current situation is a good outcome, particularly in the light of the many doomsday forecasts, which, if they had been right, would mean that prices would be falling sharply by now. But on the various pieces of evidence that are out there from the usual sources, they're not. Compared to a year ago, the capital city price indexes represent increases of 9% for houses and 3% for units. Now, two of the country's largest residential developers, Stockland and Frasers, have revealed that inquiry in their housing estates has recovered in recent weeks. Although they say that buyers remain reluctant to commit to big purchases. Stockland says that sales of residential land dropped during April, but says it's now in recovery mode, with new inquiry levels recovering to be in line with those pre-COVID-19 levels. The company this week gave a bullish take on the prospects for recovery in the housing sector, saying that an undersupply of housing is already emerging as activity levels among private developers have fallen. Now, vendors are becoming more confident, with listings of properties for sale set to rise significantly over coming weeks in an early sign of recovering housing confidence. CoreLogic data shows that pre-listing activity, which is measured by the amount of comparable market analysis reports, that CMA reports, generated on its website, rose 10.6% over the week ending 10 May. This CMA metric is considered a leading indicator for new for sale listings volumes and is used by agents to get information on individual property and market trends, often to prepare a home for sale and set an expectation around pricing. And CoreLogic's research analyst Eliza Owen says the rise in CMA points to more listings coming to market. Owen says consumer sentiment has bounced back significantly over the past few weeks, with May results of consumer sentiment regaining 80% of what was lost in the index over March. She says, for now, it would seem that people are more confident about selling property. Meanwhile, Aussie Chief Executive James Simon claims that the housing market and property prices won't drop as much as being predicted by some, and says he is pushing ahead with new plans to expand the mortgage broking group. Simon says Aussie is seeing a significant spike in activity, with some of it caused by refinancing of loans and borrowing for renovations, but Aussie is also seeing more overall mortgage business in recent weeks than at the same time last year by a clear margin, he says. And while he expects a softer housing market, he is not expecting a sharp downturn in the market. He comments, "Do I think real estate will plunge? No chance. While interest rates are low, the sector will remain sound. I have no doubt the market will come off a little, but with interest rates so low, it's just as affordable to pay off a mortgage as it is to pay rent." Turning to announcements about infrastructure, construction on Charles Darwin University's $430 million CBD campus in Darwin is set to begin as early as July. A university spokeswoman says the university expects to submit its development application at the end of this month, and the Northern Australia Infrastructure Facility is expected to address the final steps around the CDU's loan at its June board meeting. The campus is expected to be finished and up and running by 2024. Looking at some major property developments emerging or evolving around the country, the site of the Sydney Fish Market may become home to thousands of apartments and office buildings as high as 45 stories under plans released by the New South Wales government as it seeks to kickstart the state economy. The Fish Market is expected to move to a new site at the head of Blackwattle Bay, clearing the way for a major redevelopment of the existing market site. Elsewhere, a $1 billion revamp of the Mount Druitt CBD is the latest major project to be announced in the dynamic Western Sydney economy. The green light for the rezoning proposal paves the way for 2,800 new homes to be built in the precinct, as well as new cafes, restaurants, retail outlets and commercial space. New South Wales Premier Gladys Berejiklian says the Mount Druitt CBD rezoning is one of the first projects to have its assessment fast-tracked as part of the Planning System Acceleration Program that is keeping people in jobs and keeping the economy moving. And she says this project has been 3 years in the making and marks the beginning of an exciting new future for Western Sydney. More than 2,900 construction jobs will be created to build this vibrant new hub, as well as thousands more permanent jobs when the new CBD comes to life. In Melbourne, plans have been announced for 4 new suburbs in the Hume local government area in the north of the Melbourne metropolitan area. Hume Council signed off this week on the new suburbs as part of a boundary review to keep up with the municipality's booming population. The proposals were first raised last year when it was put to locals that unprecedented population growth in this area saw farming land make way for houses and businesses, and more than 2,700 people have contributed to community feedback on the proposal for new suburbs. Now, in terms of the last word, which I always have in one of these broadcasts, Australian news media continues to report pretty much everything to do with residential property in the most negative way possible, even if it means blatantly ignoring the facts. The most recent example came with the release this week of new figures on residential vacancy rates. These showed that, yes, there has been, as expected, a major increase in the number of vacant properties seeking tenants, boosted in particular by properties previously let short-term, such as Airbnb, now seeking permanent tenants because the tourism industry has been so curtailed by the shutdown phase. But it also showed that the national vacancy rate overall was still well below the 3% benchmark. The national vacancy rate is 2.6% compared to 2.3% at the same time last year. 7 of the 8 capital cities have vacancies below 2.8%, including 3 which are below 1.5%. Now that's a pretty solid position despite everything that's happening with the lockdown. But the major sections of the media did not report any of that. Media, and in particular, the Fairfax newspapers like the Financial Review, focused all their coverage on the worst examples of high vacancies in the nation, such as the Sydney CBD. The Financial Review ran a very large article highlighting all the worst case situations, which are mainly capital city CBD areas where vacancies are typically much higher. and failed to even mention the overall vacancy figures that I gave you earlier. Now, in another example of dishonest journalism, many media outlets have reported this week that the Commonwealth Bank expects house prices to fall 32%. Headlines around the nation claim that prices will fall 32% because the CBA says they will. But the bank actually didn't say that at all. What it said was that in its base case scenario, it expects a certain level of economic decline and a certain level of unemployment, and that will mean prices may fall by up to 10 or 11% in some markets, which is a fairly moderate outcome and one that other forecasters have suggested. But the bank also presented its absolute worst case scenario, in which the downturn would last much longer than it expects and unemployment would go much higher than it expects, in which case house prices could fall by up to 32% in some areas. But it did not expect anything as serious as that to actually happen. But the headlines around the nation claim, dishonestly and with a blatant disregard for accuracy and truth, that this was what the big bank is actually expecting to happen. Sadly, another lie from the nation's journalists, and one that may cause considerable anguish unnecessarily to many homeowners across Australia. And yesterday I listened to a discussion about this story between two reporters on ABC radio, and what those reporters presented was that the value of everyone's home is going to drop 30% because the Commonwealth Bank said so. The whole debate in that radio program was about the repercussions when it happened. They presented it as a fact, almost as if it had already happened, because the CBA said it would happen. The ABC reporters did not mention the bank's base case scenario, the one it actually expects to happen, which is for a short recession, moderate unemployment, and relatively minor decreases in property prices in some markets. In other words, they quite blatantly and deliberately, dishonestly presented information in terms of what they imparted to Australian listeners. Sadly, just another day with the appalling news media with which we are afflicted in this country. But regardless of what the journalists write, the evidence is that we're emerging from the shutdown and heading back to some kind of normal, with consumer sentiment rising and the real estate market becoming increasingly active. Bye for now.